All right. I want to officially welcome each and every one of you to the next phase of your trading career or your passion, following your passion as a trader. Our ability to grow as individuals totally depends on our ability to learn and unlearn. Okay, there are a few things that have been taught to you prior to this time that if you must make progress as an individual, even in your personal life, you must be able to learn, unlearn, and then relearn a few things. Okay, that is the cycle of growth. Okay, and I'll take instance to the definition of a verb. While you're in primary school, you were told that a verb is an action word, a doing word or an action word, right? But as someone who studies English or studies diction or studies any of those that has to do with grammar in school, in the university, in high school, you cannot actually give that definition of a verb in an exam and pass. So if you're in the university and then they ask you what a verb is, and all you could say about a verb, that a verb is a doing word or an action word, I'm not certain you would pass that course like you should. Because as we make progress in our field, as we strive for mastery, there are a few things that we must continue to progressively adapt to. Okay, there will be changes here and there will be growth, okay, in the midst of all of this. So moving forward, we will be growing through a few things that we had learned prior to this time, and we will be revisiting them. Okay, so we'll basically be on learning to learn and relearn a few concepts that will be key to our mastering of the craft as traders. Okay, so 5 months from now, you should be able to receive a certificate of participation as a certified professional trader from the academy. Okay, yes, we'll have an exam after, an online exam after this course. Everything is supposed to have rounded up in 5 months, but in 5 months you should be a master. In 5 months you should be able to do it as well as I do it. That's the plan. Okay, and then you should get certification. Okay, but then everything that would happen within the space of 5 months should be able to shaping your life and shaping your career or your profession as a trader. Okay, there's a saying that you can take the horse to a stream to drink, right? But you cannot force the horse to drink. Okay, so in course of those sessions, I will be taking every one of us to the stream. And then I will try as much as I can to advise you to drink. But what I would not do certainly is to force you to drink. Am I making sense, guys? Okay, so
yes, sir.
Yes, sir.
I just want everybody to work with me as we make progress and adapt to these lights that we'll be studying this week and every other week throughout this month, the next month, and 4 other months to come, dealing with smart money concepts. And page on progressive. And I believe it is going to be an amazing time. We would have amazing time together doing this together. So let's, without wasting much of our time, we'll be talking about a few concepts today and then trying to define those concepts. Okay, so today should be introduction to smart money concepts, as we'll be looking forward to defining concepts and then trying to make meaning out of everything we'll be defining. So let's make progress. Okay, I think I'll be dealing with, I sent some definitions to the group for those of you who are on the group, right? I think everybody here is on the group. So I sent some definitions to the group. Give me a minute, let me try and clear all of this. trading views acting up. I don't know what the problem is.
No, I didn't.
Okay, so very quickly, let's just run through a few things. So I talked about the concept of liquidity. We were talking about the concept of inefficiency, the concept of fair value gaps, the concept of supply and demand, the concept of order blocks, the concept of what else do we have there? Inducements, right? Somebody just check through the note very fast so we can make progress.
Yes.
We have the demand zone and order blocks, liquidity, inefficiency.
All right. Okay, so let's start with what's the first one on the list?
Supply and
Inducement.
demand. Supply and demand.
Okay, not on the definitions, the list for the
Okay.
blah 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 sense. The scheme of work we'll be working through. Supply and demand are the first, right?
Yes, sir.
All right then. All right, so I'll just be touching, probably I'll touch all of them today as it regards conceptual definitions. Okay, and then we'll make progress from there. Is Val here? Val, are you here? Oh, I think he's not here. All right then. Supply and demand. Let's make progress. So what is supply? Okay, what is supply? What is demand? Now, one thing you should try to follow me closely with in course of this session is that a lot of things that we'll be saying may sound too complex. Okay, I was talking to one of us, I think it was yesterday or so, and she said there are too many jargons involved in SMC, and then it is nothing too extra. Okay, you just have to work with me closely, and then over time you'll get used to them, and we'll make progress. Now I said supply and demand. Okay, I gave a definition of demand zones and supply zones. I said demand zones is where all the big buyers are located, and supply zones are where all the big sellers are located. As simple as that may sound, okay? Now, very quick, we'll begin to jump into, as we talk about a concept, we jump into illustrations, we talk about a concept, we jump into illustrations until we can achieve it in period. So I said a supply zone is an area where the big sellers are situated or located or waiting, right? While the demand zone are where the big sellers are waiting to, big buyers are waiting to buy, right?
Yes, sir.
So when I mean big sellers and big buyers, I'm simply referring to institutions. I'm referring to banks. I'm referring to people with large fundings. I'm referring to whales. And by large fundings, I don't mean $10 million. I don't mean $5 million. I mean people who have heavy funding, okay? So when I say supply is the area where we have the big sellers located and demand is the area where we have the big buyers located. I'll give you a quick illustration on that, okay? Now, for price to move in a certain level, where are my notations? Give me a minute. Give me a minute. All right, for price to move in a certain level from point A, okay, to point B, at this point, there have to be some certain level of momentum at this point here that carries price all the way from here to here, right? Now, we are traders. We are not magicians. We're not gamblers. As traders, it means the only thing that can cause price to move drastically from a point of discount, okay, to this area here, it has to be funding, it has to be money, it has to be orders, right? So what causes the heavy movement in price has to be an heavy bullish order or a heavy buy order. And then as retail traders, we cannot command that kind of a movement. listen to me again. As retail traders, we cannot command that kind of a movement with your $10,000 funding and your $5,000 funding and your $100,000 funding, even your $1 million funding. After now, go and make research how much lots you need to move price by a pip, and you'll be wowed. So when we talk about the big boys, you understand the kind of funding these guys have to be able to cause price to move drastically to the upside. Okay. So this level in price, where price gathered that momentum to be able to move to the what upside, becomes our level of what demand. I told you demand is where we have the big buyers located, right? And then if price gets to this area and then it falls drastically, okay, automatically we have an area where we have big sellers located. This should be what? Supply. Now, view demand and supply the same way retail traders view support and resistance. So in smart money concept or in institutional concepts, okay, you can choose to call it smart money concept or institutional concept, whatever you choose is your choice. In smart money concept, we are not looking at support and resistance. We are looking at demand and what? Supply.
Supply.
Okay, because at this point, we are refusing to trade like retail traders. We want to trade in the direction of the people who actually cause the movement of price. Okay, so we are viewing price instead of from the perspective of support and resistance. We are viewing price as supply and what? Demand. Okay, now another illustration of what a demand and supply level could be. Now, something happened here, right? That caused buyers to take over the market. Let's assume price was going in this direction before now. Okay, and then we got to this area here, right? And then automatically we took out this, okay, and then price continued to move to the upside. Automatically, what has happened here is a change in market trend, right? A change in market structure, a change in trend, right? Good.
Yes, sir.
This area here that sponsored this change of trend becomes your primary level of demand. Okay, so this is your primary demand that began the overall move. This is your primary demand. And I said it is an area where the big buyers are what's located. So what demand does is that whenever price begins to retrace back to this point and price gets here and touches this level, because the big buyers are located here, what should happen? We should begin to see continuation of the upward movement. The same thing applies to supply. If this here is a level of supply that is eminent, what should happen is that when price gets to this level, we should begin to see drastic move to the what? Downside. Okay, so demand and supply are very simple. Where it becomes technical is in trying to do the proper application of demand and supply and knowing what demand levels to use and what supply levels to use. And then we'll be dealing with all of that as we make progress. Okay, so you just have to follow. You just have to follow one step at a time. Okay, so the demand zone is where all the big buyers are located, and the supply zone is where all the big sellers are located. And I said in the definition that you can see how fast price would always react when it gets to any of these zones. Okay, now the next concept on our list is the concept of inducement. The concept of inducement. Oh, God. I don't know why my MT5 is acting up and all of that. So I can actually type. Okay, just work with me, okay? Now, inducement. What is an inducement? Okay, so I'll read through the definition I sent to you guys on the group. I said inducement refers to the formation of a trade setup in form of chart patterns. Okay, underline that. Okay, the idea of inducement is to what? Induce or convince buyers or deceive buyers or sellers into taking a trade or entering the market. So basically, the function of inducement is to cause multiple and tons of engagement in the market, basically for the purpose of creating liquidity. I'll go over it again. The idea behind inducement is to convince traders to engage price by creating chart patterns that fits either their buy setup or their sell setup in course of technical analysis. The idea is to deceive, is deceptive, okay? The nature of inducement is deceptive. The idea is to make you feel that we are going to make a buy and then you are jumping into a buy. Even if you end up making a buy, you jump into a buy and then we take you out before we continue in your buy. I will give you quick illustrations of what an inducement are. Now bear this in your mind, the keywords, creating chart patterns. Keyword number 1, creating chart patterns. The idea is to convince buyers or sellers to take a trade or enter the market. So basically, the function of inducement is to cause engagements. By engagement, we want people involved in the market. We want buyers in the market. We want sellers in the market. And then don't forget, as you are loading your orders, as you're loading your tons of orders, that is how much money we have in circulation inside of that market space. Okay, so we want people in engagement. We want people to engage price at that point. That is a function of liquidity, to deceive you into engagement. Okay, so before we go to the next line, which is basically for the purpose of creating liquidity, let's deal with how the inducement forms, okay, or what inducement looks like. So the first keyword, chart patterns. Now let's take this very quickly. Very quickly. Let me try and use my pen. All right, good. Let's see this. All right, I'm good now. All right, so let's assume we are on an uptrending movement, right? And price is trending higher, and then this happens, right?
Yes, sir.
Now, if you trace the story of price that we have on here, price has given us series of higher highs and higher lows, right?
Yes, sir.
Am I correct? And
Yes,
then
sir.
suddenly we have a change of character over here, right?
Yes, sir.
And price broke down and formed what we should call a triple bottom formation, right?
Yes, sir.
Right?
Yes, sir.
Yes,
Now, what is the first keyword I mentioned? The idea of
patterns.
inducement is to create what? Chart patterns.
Pattern.
What are your chart patterns? Your double top, your double bottom, your triple top, your triple bottom, your head and shoulder, your trend line channel, your bearish
rising
flag,
wedge.
price action, exactly, rising wedge, price action
wedge.
patterns. Okay. Kelchizi, are you here? Is Kelchizi here? All right then. So we are creating chart patterns, retail chart patterns. The idea is to convince buyers or sellers to enter into the market. Now, do not forget that before I talked about inducement, I had talked about demand and supply. And I told you that demand is what? The level where we have the big buyers.
Big buyers.
Okay? And that is the level that actually
Yes,
propels the move. So we have our big buyers sitting here.
Yes, sir.
Okay? So with the chart patterns, buyers are convinced to enter the trade at these points, right? We have tons of traders in the world. We have traders everywhere, Nigeria, outside Nigeria. Traders everywhere in the world are taking buys. In fact, some months ago, Billion Banks is taking buys on this setup. Triple bottom, their father. We kill it. Okay, so the idea is to convince you to take buys, and then they push price upward a bit to make you feel, this one. Originally, we were taught to wait for a neckline, right? People who learned from me knows you don't trade on the breakout, you trade on the breakout of the correction. I don't want to go into the details because we are talking about smart money now. Okay, so what they do is that they induce you into taking the buyers, and then we have tons of orders there. And what do? They push price downward. Where do they take price to? Where do they take price to? Where we have the big buyers. Demand. Don't forget, the big buyers and the big sellers are the one controlling the movement of price. Now, the algorithms we use on synthetic index have been programmed to follow the behavior of the big buyers and the big sellers. Okay, so they push price to these points, and then what happens here? Your stop loss has been hit. Your stop loss has been hit, right? Okay, I will get to what happens here after I finish talking about inducements. Okay, and then after that, they launch price to the upside, and then they do this. Okay, and then you will not message me, say, but sir, the market stopped me out and continued in my direction. But sir, I saw the triple bottom. Maybe my stop loss was too tight. It was not too tight. It was never too tight. The idea is to induce you. The idea is to convince you, according to what you have been taught to trade and live by, that what is actually happening is a triple bottom. Now, imagine this in this scenario. If the whole world, go to your Google and type triple bottom, automatically what you come out is buy. True or false?
Yes, sir. True.
So if the whole world can see this buy, do you think the market makers want to dash you money? Like in trading, we come here to do giveaway. We don't do giveaway on the charts. Whatever setup that you see that is too obvious for everybody. In fact, the guy who learned trading on baby pips will tell you this buy, load 50 lots. Okay, if everybody in the world can actually see the setup, then the setup is an inducement. If every other trader can see the setup, then the setup is an inducement.
Inducement. Wow.
The idea is to convince you to take the setup. And then when we have tons of orders, we have loaded orders. So inducement convinces you to take the trade. So what then is liquidity? Liquidity throws you out of the trade you have taken and continues in your direction. So inducement invites you into the market. Liquidity kicks you out of the market. Okay, now do not forget that on the last words I said you should mark, I said the idea is to induce or convince buyers or sellers to take a trade to enter the market. So basically the function of inducement is to cause multiple engagements, buy orders, sell orders, buy limits, sell stop, buy, all of those rubbish engagements are here. I will tell you what the engagements are for. Basically for the purpose of creating liquidity. Before I explain that, what is liquidity? Now, liquidity, on the other hand, can be seen as the fuel that drives the movement of price in certain zones. Okay, so liquidity serves as the fuel, as the gasoline, as the energy that drives the momentum of price in certain zones. Now, look at the next line. I said we can find liquidity in zones where we have lots of retail orders, such as stop losses, buy and sell pending orders, sell limits, buy limits, sell stop, buy stop. The logic. Okay, let's deal with this very quickly. Just follow me, okay? I am taking us to a promised land that you like. All of this. So it does not disturb our promised land we are going to. All right. He's laughing like feet on the background. All right.
Anointed.
Great. Anointed. How are you, my darling?
I'm fine.
All right. So now what is happening here as a result of this triple bottom? Now, don't forget that as a trader, that thing you are buying, somebody is selling it. I'm teaching you these things as Nigerians, so forgive my diction. You just have to learn it, okay? That thing you are buying, somebody is actually selling it. I'm surprised how I just have 10 minutes. Oh, wow. Okay, we'll have to do 2 sessions today until I'm willing to subscribe or the Zoom meeting. So let's just make progress. Now, inducement, liquidity. The liquidity refers to the tons of orders that will be taken out. Under this level, where we have people entering for a buy, we have other people that have set buy stop under here. We have buy limits above here. We have the people that are waiting for this place to break out, so they will take sales. So people who trade total breakouts have set sell orders, expecting that if this line breaks out, it will trigger their sell and they'll get a retest and continue downward, and then we'll go bearish, right? So we have lots and lots of orders inside here. So we have the sellers waiting to engage price below this level, and we have the buyers waiting to engage price above this level. I'm hearing myself on your speaker. Please mute the mic. Thank you. So what happens is that price will give you the impression that we are buying, and then we'll move further downwards to hit the stop loss of buyers first. Okay, so buyers are out of the market, and then trigger the sell position of what? Sellers. Okay, but then still continue downward to hit the stop loss of what? Sellers. So both people who bought and the people who sold are out of the market.
Okay.
And what has it created? It has now created fuel for the big guys who are sitting here to now use that your liquidity that was taken out as buy and pending orders will now serve as extra momentum for them to push price to the upside.
Wow.
Is it making sense?
Yes,
Yeah.
sir.
Okay, I'm trying to simplify this concept, so when you hear the name, it is not, I don't want to go into the whole logic and the whole, so I'm just breaking down the logic into simpler bits that you can understand. Okay, so when you hear about inducement, it is simple deception. Inducement is deception. They're trying to deceive you into taking a move that they may continue in that direction, but not at the moment. They can't continue at your terms. This is why they can't continue at your terms. Hopefully they were willing to buy this market, but they need engagements. So if they are going to buy this market with 10 million lots, okay, firstly, they would open 3 million lots at this point. I'm just giving you an example, okay? So let's assume they had first opened 3 million lots at this point. So we can invite more buyers. And then you begin to see higher highs and higher lows. So as buyers, what will happen? You will enter the market and buy, okay? They're trying to invite you, okay? And then you see price move in this direction and change character, right? And then gives you a triple bottom. What does this also do? It has invited more buyers to the what? Market. Right? Now,
Yes.
but don't forget that as we're inviting buyers, they had only opened like 20% of their lot sizes at this point. Okay, so what they have to do is to bring price back to an area that is comfortable enough for them to buy again. Okay, so at this point, for this sale to happen, they may open sell positions here of maybe 10 million or 1 million. They may open sales of probably a 1 million lot at this area. The idea is to cause these sales to what happen. Just follow me closely. And they cause these sales to happen. The same people, the big guys, the big buyers, the banks who open the buy, also open the what sell position. Why? So they can also have sellers involved in the markets. We need all of you guys in the market. It has to be a full table. Okay, what makes the market print higher highs and higher lows are because of buys and sells. Okay, so we need all of that in the market. Okay, and then we create an inducement to convince buyers that we are still on their side. Even if we are still on their side, we are not willing to take price up immediately. Okay, because that area, for example, at the moment we bought here, what we bought was for 5 naira per order. Example, okay, we bought it for 5 naira per order. Just follow me closely. And then you expect us to come here that it is about 7 naira per order and buy again, when we have the ability to take price to 5 naira before we buy again. So they have to take price to a more discount price that is more comfortable to them to buy, where they have previous orders. And when they get there, they open the rest of their positions. That is what caused the heavy impulse to the upside. Now, do not forget that I also told you that the same people are the ones that opened the sale here, right? And the idea of the sale they opened here was to do what? To cause sellers to enter the markets. Okay, which gives us another inducement. What is the inducement? Double top, resistance level, key zones. Okay, so when they get to that level, the only reason why you see them push price downward again is because they had opened a sale here previously. Don't forget. And that sale that they opened here, they cannot close in a loss. So when they get to this point, they will allow price drop, so they can close out some profits for this initial sale that they had opened at this level. And once we do that, they will pick out a new area of demand inside of an order block here, and they will force price to move to the upside. So this inducement here, what do we have up here? Liquidity. People who were sending, placing sell orders, spending sell orders, or pending buy orders. So most times they will break it, trigger the buyers above here by a few people, and then dump back into the sale. So we have put buyers in loss, we have put sellers in loss. What are we looking for? Orders to fuel the market. Those orders that fuel the movement of price are what we now call liquidity. Okay, so they have grabbed on liquidity at this point, right? And then they have to put their position in profits. So they allow price dump while they take profits off this position. Their initial mind is to what? Buy. Don't forget. Their initial mind is to buy. Their initial intention are still buyers. The essence of this was to convince sellers to come into the market. So that the essence of inducement is for what? Liquidity. I told you the idea is
more liquidity.
Exactly, more liquidity. Anywhere you see inducement, what should come to your mind is the creation of market needs liquidity. Market needs liquidity. That is why we create inducement. Okay, so they let this play out and then they tap out liquidity on here. Then they come back to a new level of what? Demand. Something I would like to call your demand 2.0, as explained, always explained by Mint FX. Okay, and then we have this amazing move. Touch here, and then we'll see this to the upside. Okay. Does that make sense?
Yes,
Yes,
sir.
sir.
It does.
Now, did you observe that we have simply merged demand and supply together with
The market
investment and together with liquidity?
Yeah.
Okay, so everything you see are just so many big names. They are not difficult. They just have big names. Okay, so inducement simply refers to the setup or the recurring price action or the recurring chart pattern on your charts that is supposed to invite you to take in a trade. So inducement invites you to engage in the market, while liquidity takes you out of the market. Now, do not forget that I said, I hear too much noise on the background. Please, somebody help me. Do not forget that I said your supply level is your level where we have the big sellers, and we had the big sellers here, right?
So
That is why price had to do this for a while, just to get to a level of demand before they continue upward. Okay, and then once a demand level fails to hold, once a supply level fails to hold, rather, it transfers power to a new level of demand. So price will continue from that point and continue the higher highs and higher lows. Does that make sense?
Yes, sir.
Good. All right, I'll be sending a new link shortly. I have a few seconds for this. A new link is coming immediately, so we can proceed.
Okay.
All right.